Alright, so where we left off in the last video was walking through a trade from start to finish. We're going to do another example. I'm going to use crude oil once again, and we're going to talk a little bit more in detail about how to trail a stop, how to utilize the trailing position for bigger moves. Okay, and what we're going to do is walk through a recent crude oil inventory report. This is one of the trade plans that we love to trade. We trade crude oil 5 days a week. We always start at 8:50 Eastern Standard Time. Of course, I'll teach you how you can go ahead and perhaps develop your own trade plan where you can start later in the session or maybe even earlier in the session, or you can just begin using the trade plans we use. It's a great way to go. An additional trade plan that we use is it allows you to trade an extra session every week. And so once the crude oil inventory report comes out, which is typically on a Wednesday at 10:30 Eastern Standard Time, sometimes it will be on a Thursday if there's a shortened week due to a holiday. But we always wait for the report to come out, then we wait 2 minutes and we start looking for trades. Okay, so this is a great example of how we could utilize our counterpunch tools to really knock the ball out of the park for larger moves. We'll look at examples just like this with other markets, including Forex and stocks, but let's just pretend it's any old market, doesn't matter. Let's just learn the proper way to trail using the counterpunch trader momentum indicator. Okay, so here we are. You can see it's 10:32. The report just came out. There was an earlier setup at 10:31, 1 minute after the report came out, which set up a beautiful short trade. But the volatility is such that when the inventory report comes out, we want to wait at least 2 minutes. That's the trade plan, and we just want to stick with it because it's been doing so well for so long. It's not broken. Let's not fix it. So we're waiting for the next setup, and we get a long trade. After a nice short trade, the first trade at our time at 10:32, right, 2 minutes after the report, ends up being a counterpunch trade. And we know that because it's white. The histogram has confirmed it down below with the cyan crossing over the yellow. We don't need to know this already because the calculator does, but just to keep reviewing so that you get the repetition of understanding, the set of dots is lower than the first set over to the left and the second set over to the left. And that gives us a possible setup to go long. First green bar closing on the other side of the momentum line, beginning on that third dot, could be as many as 4 bars over. On the very next bar, it comes up and triggers in. We know it triggered in because the entry is at 44.94 and it stabs up to 44.94. Now there's one other thing. I've already introduced this to you. I'm going to talk about it again. In the next section I will explain it in greater detail, and that's this whole idea of key level adjustments. Some trade plans are going to utilize what we call a key level adjustment. So this entry, actually we would have moved it from 94 up to 96 because typically we're going to work around 5s and 0s. If we get close to a 5, we move it around the 5. If we get close to a 0, we move it around the 0. Again, I'll explain this in greater detail. But this entry is actually not at 94. It's at 96. Okay, and this is just one of the techniques you will learn, and you'll get used to it. It seems kind of weird at first. So I'm just going to show you where the entry actually is. Okay, now the calculator is going to show you the setup. But these little extra rules that we apply, we call them the 5% art to trading. We reduce them down to rules. It's a mechanical rule. We just have to get used to it and remember to do it. Okay, so it still technically hasn't really triggered in yet. All right, so we're waiting, and then finally on the next bar it does push through as high as 97. This should be probably right there. Okay, and now the trade is a live trade. Okay, so remember what I taught you on the training. We have to get to the money management level before we can lock in. And so right now the price is going against us, but our stop is down here at these dots. Okay, and you just can't worry about what happens when the trade is in its early stages. Sometimes it will be a losing trade. We get an additional setup to go long right here. Now this can confuse people if you don't understand the strategy and the trade plan. You'll know that's a green trade because it's a failed swing. It failed to get lower than the last exhaustion level. It creates another exhaustion level at a higher low. So it's starting to make higher lows, and hopefully it's going to make higher highs because that's what's going to hit our targeting. Now, can you add to your position here? You can. That's always optional. It's a more advanced technique. You'll certainly want to practice it. It also increases your risk. With Forex, we're probably going to want to do this more often because we have the ability to go smaller with our position size. But with crude oil and with futures, you can't go smaller than the contract because all the contracts are standardized. So just keep that in mind before adding to your position. As it turns out, it cancels. And instead, it looks like it wants to go short. And that would be a losing trade, right? But instead of losing at the stop here, the risk is reduced to the entry. And so you cut the risk in half, and you possibly have to now stop and reverse to short. However, part of the art of trading is how we handle stop and reversals. When we stop and reverse, there's a concept I want you to start thinking about, and then I'll explain to you some of your possibilities later. But the main concept is this. You want to try to protect the trade you're in already, in this case a long trade, while also respecting the fact that maybe the market's changed and it's going to resume its downtrend lower, which gives us a chance to cut our risk and get on top of the winning trade. But remember, we also want to protect the trade we're in because we don't want to get a false signal down and then it turns up and goes higher. That could be a perplexing problem. And this happens regularly. Again, remember, we have no control over price action, but we can put the odds on our side. So the technique that I always use is I want to ask for a little extra confirmation before reversing. So just like a key level adjustment, where I adjusted this up a couple ticks, I'm not going to jump on this short right at the entry. I'm going to ask for 2 more ticks and then get short. I want it to go 2 ticks lower than the entry, and if there's a key level adjustment at that point, I might even adjust the entry a little bit lower. So I have to look at the situation. And when I teach you key level adjustments and we talk in greater detail about the idea of a stop and reversal, protecting the trade you're in while respecting the fact that the market could be turning. Trying to find a compromise that still puts the odds in our favor will eliminate some of the false stop and reversals. That's enough to be very successful with a trade plan that will grow your equity. This is important. All right, I look at this short here and I see there's a short at 79, so I'll put in an order to go short and reverse my position at 44.77. I'll add 2 more ticks, and the next bar stabs down to 78, right? And then look what happens. You have another short setup, and then it goes up. And because I made a small adjustment of 2 ticks, I actually stay long and I don't reverse position. Another clue, of course, is the histogram. Notice the cyan line is above the yellow and moving higher. So I want to protect my long position, but this could change. This could go short and go down, and sometimes it does, and quite often we're happy to stop and reverse. But in this case, we wouldn't have been. In this case, we would have had a partial loss, and then we would have got short, and then it would have went long and hit the stop right here, and then got long again. Whereas if we just stayed long the first time, we're in a better situation. We can't avoid this all the time. Sometimes you'll get 2 losses in a row. That's pretty common. That shouldn't scare you. Usually you're going to get a big winner that's going to make up for it. In this case, we're able to stay long because of some art of trading rules that we can apply over and over again in a mechanical way. In other words, we have the rule, we just follow the rule. 2-tick adjustment keeps us long, protecting the long trade while respecting the possibility of going short. So we ask for a little extra insurance. Look what happens. It pushes higher and higher. Hits the money management level right there, all the way to there. So we're going to move our stop from its original location all the way up, and we're going to lock in a tick from our entry. Okay? So our stop's going to move up to there. Remember, this was the entry, right? But we're going to move our stop from here, lock in a tick, and we're also going to start trailing the signal line. And it goes higher and higher, and it hits target 2. Almost hits target 3, but notice the signal line is moving up, so we have to be trailing it 2 ticks below. And with every bar that closes above, we get the new reading right here in the data window, and we trail it 2 ticks below, and then we might make a little adjustment around a chart level or a key level, but by and large it's 2 ticks below. And notice that it missed target 3 by a tiny bit, trying to get to 45.30, and it gets as high as 45.28. So it misses target 3 by 2 ticks. Now if you're going for target 3, you could stay with the trade. You could take a partial profit if it comes back and hits target 2, which it does. But by just staying with the trade, that's also good because you already have profit locked in with your trailer. Remember, you want to try to stay in the trade while mitigating risk. So you have options, and a lot depends on what market you're trading and how large of a position. With Forex, you could certainly come off with part of your position at the lower target, right? If you just barely miss the full target, target 3 that is. And you could keep some of your position on to trail. So it really depends on what market you're trading, but you have a lot of flexibility here. The idea is to make money and to follow the rules of your trade plan. But notice also the 50 EMA is starting to curl up. You've got the trend that seems to be going strong. The spread between the cyan and yellow line is widened. And a lot of times we know that when the 50 starts bending up to the 200, just like here it was bending down, it wants to try to come down and meet it, possibly cross over and keep going. And we're just seeing signs of that here. Boy, staying with this trade could lead to a larger move. And we've got the momentum line showing us the balance between buyers and sellers, and we're trailing a little bit behind it, a little bit below it. And the momentum line went up again. And you could take the reading. Here it's at 13. We're going to move our stop down to 11, and we actually work around the key level and the 50 EMA, and we'll just keep it at 09 because that 50 EMA is right at 45.10. And then it goes up again, and this time it's at 18. So instead of moving it to 16, we'll work around the 5, and we'll put it at 14. Now, I just made a mistake. Why did I make a mistake? Well, this is subtle, but it makes a big difference. Remember I said that every bar has to close above the signal line before we move our stop. This bar closes at 45.18 and the signal line's at 45.18. It didn't close above the signal line. It closed on the signal line. That's not enough to move our stop, so we really need to keep our stop down 2 ticks below the signal line and then adjusting around the chart level. And so we don't move our stop. And then the next bar closes below the signal line and it stabs all the way down to 45.13. It would have stopped us out right here, except for our rule that the trailer is based on the last bar that closes above the signal line, not on the signal line. If we're going short, it would be the last bar to close below the signal line, not on the signal line. So our stop is still here. We're risking a little bit of our profit to try to stay in the trade utilizing the information that we have on the chart. Key levels, chart levels, indicator levels, right? Look what happens. It pushes higher, and the signal line starts moving higher. And so we can move our stop higher. The signal line is at 20. We can move it to 18, or we can keep it below the swing level like that. If we push it to 18, this is going to stab down to 17 and stop us out. But because we have a little swing level here, we can work around the chart level and keep that stop a little bit lower. And then it pushes higher, and the signal line keeps moving higher, and we keep moving our stop higher. So now the signal line's at 25. We can go to 23. Can we work around this 200? We could. We can keep it a little bit below, but then it moves up again. We don't want to make huge adjustments. Moves up to 27. We can put it at 24. 25 is a pretty big key level. Those quarter century numbers, multiples of 25s. We want to work around those. So we don't want to put that at 25, but we will put it at 24. And it goes higher and higher, and like this we keep trailing and trailing, and look at it go. I mean, yes, if you did stop out, you could have taken another setup. If you did happen to stop and reverse here and get a partial loss and then a full loss, you would have picked up the long trade all the way up to full target. You would have picked up another trade if you didn't continue trailing with this technique. But these are the rules we employ in our trade plan that help us with the small part of trading that you just have to be a human being to be able to do. It's the art of trading. And the more you see it, the more you learn the rules that we employ, we reduce the art down to just rules to follow, a mechanical set of rules. This is all trading technique, okay? But it's based on the art of trading. As it keeps going up and up and up, notice that the 50 did cross over the 200. Notice that the trend is going stronger and stronger. It looks like it might roll over. There's no way to know for sure. It looked that way here as well, down in here, but we used our smart art techniques to stay in the trade. Finally, the signal line moves up to 59. We have no real safe place to hide our stop. Sometimes you do want to get out tight. That's going to go up to 57. The next one closes at 69, above the signal line at 61, so we can move our stop to 59, 2 ticks below, and it goes higher yet. And notice that it stabbed down to 60, and the 2-tick trailer is keeping us in the trade for an even bigger move, and as it keeps moving up, we keep moving up the trailer. So now it's up to 65. We move our order up to 63. And it goes more and more, and it keeps going up and up. Finally, it starts to flatten out. It's crossing over down here. This trade might be close to over. The signal line's at 73. We're keeping our stop not at 71, but around the 0 at 69. And it goes even higher yet, all the way up to 75, which means I could put my stop at 73, which is right there. And then it comes and stabs down to 74, and on the next bar it stabs down to 73. If I'm going to take another trade, I don't need to adjust my entry on this stop and reverse, because the entry's at 72, my stop was at 73, but also because it's already a profitable trade. I don't need to protect my long trade anymore. Nor do I need to take the short trade, even though it looked like it was going to be a winner, and it ultimately was, because our trade plan would have had us quitting with our profits in hand. Okay, and we didn't talk about those concepts yet, but we certainly will. All right, so that's a real detailed look of how to trail For short trades, you just do the opposite based on the last bar that closes below the signal line. All right, the next section, we're going to talk about key level adjustments. All right, well, there are different ways you can do your layout on your desktop. A moment ago, you saw me with the calculator data window over on the left side of the chart. Some traders like that. Another way is to set it up to the right off the chart so you don't have any obstruction on your chart. And this is how I personally like to set it up. Doesn't really matter because with TradeStation and with NinjaTrader, the data window is going to float around and you can move it, okay? But with MT4, it's always going to be on the left. So you just get used to looking at it. And I'll show you examples of MT4 when we get to Forex. Okay, so let me talk about key level adjustments. There are 4 types of key level adjustments. All right, let's discuss them one by one. All right, so here are the 4 types of key level adjustments. A minor key level adjustment, a major key level adjustment, a chart level key level adjustment, or we can just call it a chart level adjustment, and an indicator adjustment. Okay, so let's take the first 2. The first 2 are referring to the price quote itself. We're adjusting around certain prices that tend to have a psychological effect where it takes more effort to get through. And some charts, like with crude oil, the Russell, the Dow E-mini, the minor key level adjustment is going to be any quote that's a multiple of 5. So it might be for crude oil 45.15 or 45.20 or 45.35, right? Multiples of 5. The Russell E-mini, it might be 1047.5. For the Dow E-mini, perhaps it's 16155. Okay, multiples of 5 or 16160. All right, those are all minor key levels. And usually, if we get to within 1 tick of that level, we adjust 1 tick beyond that level. So if you go back to our original setup here on crude oil, the entry was at 4494, right? So that's 1 tick before the minor key level of 95, multiples of 5. So instead of getting long 1 tick below the key level, we'll go 1 tick beyond the key level and make a 2 tick adjustment on the entry. So we get long at 4496 instead of 4494. Just a small adjustment, and that will often make a difference between getting into a trade that stops right at the key level and then reverses direction. Doesn't happen all the time, but when it does happen, it's nice to know we can avoid it. It's like a small insurance premium. Okay? And that's what a minor key level adjustment is. It's usually when you get to within 1 tick of a price level and you adjust it 1 tick beyond. Now, if you land right on the key level, you still just go 1 tick beyond. Okay? Now, we do that with entries and stops. So the entry we push further away because we want to ask for extra confirmation for the price to move a little further through that key level before triggering us into a trade. And for stops, we push the stop further away because maybe that's enough to keep us in a trade. The price might come all the way down, hit that key level, and then go back up again. If we didn't make the adjustment, we might get stopped out. But by making the adjustment, we often get to stay in the trade. And it's worth paying 1 or 2 ticks to try to stay in the trade because remember the philosophy of the strategy. Always try to stay in the trade while mitigating risk. And you mitigate with a reasonable amount of discretion, 1 or 2 ticks, because you don't want to skew the risk-reward ratios too much. You don't want to change the setups too much. Okay? So the general rule of thumb is you can make a 1 or 2 tick adjustment and that's fine. Anything more than that, is a little bit, it requires a little more information. You can sometimes make a 3-tick adjustment. You can rarely make a 4-tick adjustment. So when might you make a 3-tick adjustment? Well, a major key level is a bigger price level. Usually, like for crude oil, it's the quarter century number, 25 cents, 50 cents, 75 cents, 00. Okay? But sometimes some traders will use the 25 level as a minor key level, and only the 50 cent and dollar levels are major key levels. It's really up to the trader. That's what I do. It's like I will only use the 50 cent level and the dollar level as a major key level. And what that means is that if you get within 2 ticks, so let's say there's an entry at 45.50, or let's say there's a long entry at 45.48, that's 2 ticks in front of a major key level of 50, then I'll adjust 1 tick beyond to 45.51. If I'm coming down on a short trade and there's a major key level, maybe I have a short at $44.02, 44.02, and a short entry at that level. I'll get short at 43.99. I will make a 3-tick adjustment around that major key level. Same with my stop. If I'm in a long trade and my stop is at 44.02, I'll move my stop down to 43.99 and make a 3-tick adjustment on my stop around the major key level. With Forex, I find that you really don't need to focus on minor key levels. You really just want to focus on the major key levels, and I treat it a little bit differently because with Forex, they move through those levels easier, and you also have to pay spread. So whenever you make an adjustment, you also have to consider the spread on top of what you're adjusting, and that ends up eating into your profits and adding too much risk to the trade. So key level adjustments we don't do a lot of, and as you go through each trade plan and as we talk about more markets, we'll talk about how I think you should approach the key level adjustments when it comes to adjusting around price quotes. Okay, the next level or key level adjustment is a chart level. And with a chart level, you want to be careful not to over adjust. So if you have a clear swing level or support level, resistance level, you can adjust around it. Remember, 1 or 2 ticks are okay, 3 ticks sometimes, 4 ticks rarely. So you might be at a major high of the day, for example, and you're going to adjust around that. All right? And we'll look at examples when we go through walkthroughs. And then finally, the indicator adjustment. There's a short possible entry here, and it's sitting right on top of the 50 EMA. Now, there's no targeting because this is a white trade and the histogram didn't cross over. But if it was, I would adjust the entry a little bit below the 50 EMA because our momentum line, our 50 EMA, our 200 EMA also are showing us support and resistance levels that we want to work around. And just by doing these small little techniques, we will avoid some losing trades and we will stay in some bigger winning trades. Just like I showed you with the example of the trailer moving up on this last sequence. Alright, so I realize this is a foreign idea and it might take you time to get used to it. But you're going to see a lot of examples. I will continue to point these out to you. You'll get practice and you'll improve and get better and you'll completely understand how to use key levels. The more you see it, pretty soon it'll be like riding a bike and you'll never forget. Alright, in the next video, we're going to talk about some of the filters that we use to help avoid some losing trades.